All right, I think we can get started. Hi, everyone. Thank you for joining us on our third webinar session today, Leadership as the World Reopens. It has been an interesting time, to say the least, over the past few months, and we can only assume the future holds new challenges as well. We have taken a thoughtful approach to our webinar series, lining up guest speakers who can address real-time thoughts and information as COVID has progressed, resulting in our personal and business lives being forced to evolve with the situation. A quick overview for those joining us for the first time. We started with the science and the fundamentals of the virus with guest speaker Sindora Ganapathy from the Bill and Melinda Gates Foundation, leading to Tim Warrington joining us to discuss a playbook for executives as businesses start to reopen, given his background in pandemic planning. To today's session, where we will be continuing a theme of leadership, specifically touching on the impact of COVID and how it will change management and leadership in the future, as well as some investment thoughts and strategies during the time of COVID and post-COVID. As always, we're hopeful that today's session can spark thoughts and help navigate you all through these unprecedented times. For those who do not know me, my name is Danielle Munley, and I'm a partner here at HTI. You will also be hearing from HTI CEO and co-founder Andy Towne at the end of the session for closing remarks. Please use the Q&A chat at the bottom of your screen to direct your questions live to us, and this will be recorded in roughly 45 minutes long. With that, it is my pleasure to introduce our moderator, HTI Managing Partner Wes Goldstein, and our guest speaker, Jim Barry, Chief Investment Officer of Alternatives and Global Head of Real Assets at BlackRock. Wes, I'll let you take it from here.
Thanks, Danielle. And Jim, thank you for being here today. Since people might not be familiar with your background, I'd love to just start from the beginning, really, and where are you from originally? How did you get to the role you're currently in at BlackRock?
Well, once upon a time, a guy called Noel met a girl called Claire on a blind date. But maybe I'll fast forward. So first thing you need to know about me is I'm Irish, but I'm from Cork in Ireland. And I guess it's the equivalent of being from Boston but working in New York. You're going to make sure everyone knows you're from Boston. And so, but basically that's where I grew up. That's where I went to college, University College Cork, where I did a business studies degree. And basically, I would say the first sort of 10, 11 years of my career was really all around sort of a real jack of all trades in the sense of building out a general business competence. So 4 years undergrad in business, then I got a job, great break with Morgan Stanley in London in '89, where I was in the M&A department, and that was a phenomenal experience. I got to do an MBA between 1992 and 94 at Harvard, which again was a fantastic opportunity. And then chose to go into consulting. I always wanted to manage and run a business, and so very much consulting as with Bain as a practical MBA to go with the academic. And so spent 4 years again in London with Bain and Company before, with two young kids, now 4, but with 2 young kids at the time. My wife and I, we decided to move back to Ireland. And so really, in coming back to Ireland, I had a sort of just the ambition to find a small, medium-sized enterprise, be at the top table, have equity, and live in Cork. I got 3 and a bit out of 4. The living in Cork never quite worked out, but we have a nice house down there by the sea. But basically, the company I met a guy called Tom Roach. He was the CEO then of a company called National Toll Roads PLC. It was the Irish toll road operator, 2 big facilities in Dublin. And he needed help with strategy and business development. So September '98, I joined on a temporary basis, and I stayed almost 13 years, 11 of those as CEO. So I became CEO July 2000. We basically took this Irish public company, diversified across infrastructure in Ireland, and then basically diversified internationally in the renewable energy space, because when we went into power, it was through renewable energy and wind initially that we did. And so where we saw the growth in the early 2000s and beyond was in the general renewable energy space. We did 10 startups in 10 years, some phenomenally successful, some equally phenomenally unsuccessful, and a bunch in the middle, as is normally the case. We got through the crisis. We were long a lot of growth coming through the crisis. But we had an idea for a fund, and Oliver Wyman, who did some work with us, basically said you needed a kind of fiduciary partner. And coincidentally, BlackRock came knocking on our door middle of 2010 looking to get into infrastructure. We were well known in the renewable energy space. So we said, well, you want to get into infrastructure? Here's a plan. And so that culminated in BlackRock and NTR forming a partnership launched in March 11, where we started the infrastructure business with a renewable power energy fund. As part of the deal, BlackRock got me. And so over the first sort of 4 or 5 months of 2011, I transitioned to BlackRock, along with a small team from NTR. Then we were going to raise $1 billion in 6 months. Anyone in fund management knows the game where, you know, there was all the promises. And we were just thrilled to drag our butts over the line 13 months later with $225 million. But the renewable power business is now over $6 billion and heading towards $7 billion this year of assets under management. But then I was asked to build out a broader infrastructure franchise, which I did in the sort of 13, 14, 15 period. Today, we have about $28 billion in assets under management in our infrastructure. Most of that organic, but also we made a couple of strategic acquisitions along the way. In 16, I was asked to take on the real estate business. Real estate had a bad crisis in BlackRock, and it was 3 distinct and separate businesses. So basically integrated that into one real asset platform. And over that period, end of 16, we were about 30 billion, and today we're about 57 billion across infrastructure and real estate. And then, because I wasn't busy enough and twiddling my thumbs, about this time last year, as BlackRock, we decided we need to really get more cohesion around the full alternative asset platform, which is about $210 billion of, in addition to real assets, we've got a very large private and liquid credit business, and also over 100 billion, as well as a direct private equity and a big fund-of-funder solutions business. And really, it was with a view, with it being a strategic priority for the firm and a huge amount of growth, just creating cohesion. So that brings me to the pandemic and having to get very close to $210 billion of assets really quickly. Other than that, still living in Ireland. The 4 kids are between the ages of 16 and 25, and they're tolerating the father. My wife worked out 93 was the last time we had this much time together in the one place. The fact that I'm not living in the garden shed is a miracle.
Well, so I actually want to go back to that time at NTR because, and you and I have touched on this in the past, but you described that move back to Ireland from London as being really a personal decision. But my understanding, and I think this is partially from research that I've done, is that you moved back to Ireland without a job, and the original NTR contract was part-time, and I think a 6 or 9 month contract. So help me understand what were the driving factors for you moving back to Ireland, and how did you weigh both personal and professional kind of, I guess, variables or goals? So
I would say to you that, look, and when I give this advice to colleagues and friends and whatever, particularly younger executives, is like, you got to think about life in its totality. And for me, the issue in '98 was not whether I'd leave Bain. I said I'd say 3 to 5 years. It was 4 years. There's a law of diminishing returns as a manager unless you want to be a partner, which I'd never wanted to do. So the decision was, would we spend? I was always going back to Ireland. It's a sense of who I am. My wife, the children wanted to raise as Irish, wanted to be close to their extended family. And so, in a sense, that was a given. It really was more, do I do it now or do I wait a few more years? Kids were still young enough. At that stage, the Irish economy was already beginning to boom. The Celtic Tiger, as everyone knows. And just with my network and friends, there was lots of things going on. And so from my perspective, I agreed to do a final transaction for Bain project over the course of the summer. And then it was a case of, as long as I got time to go back and network. And so I was doing the classic networking, going around talking to people. Ireland's a small place, and so I wasn't fixated on any particular sector. I was looking more for the nature of an opportunity. And I think that, when Tom came along with NTR, I think that, I didn't even know bloody well Dublin had toll roads. That's how switched on I was to infrastructure. But but he had done a Wharton MBA in the 70s. He had a sense of he wanted something extra. I didn't feel I wanted to make that kind of commitment. And so the temporary bit was me more than anything else. And I committed full time to Christmas and at least 3 days a week after Christmas for 6 months.
And I think that so I didn't see it as a big risk. I mean, I paid off all debt associated with business school, young family, but, we had a house, there wasn't a sense of, my God, I'm putting it all on the line. And I think that, kind of, for me, you hire a strategy consultant, the first thing he's going to do is say, let's look at your strategy. And so we went through an exercise through the back end of that year around basically either staying in Ireland and going across the infrastructure spectrum, or going outside of Ireland and toll roads. And we chose the former strategy. And really, by the time I got to Christmas, I got to know the people. We got alignment around the strategy and substance, and Tom was looking for a number 2. And so I really stayed full-time indefinitely. I didn't actually go permanent until the summer. I kind of kept my options at a level, but became number 2 in July 99, and became the CEO a year later.
And so staying on kind of the topic of NTR and thinking about kind of career transitioning, you once told me that what's really important for you is this continuous education, and to be able to be continually challenged and to take on more, I guess, different opportunities as you progress in your career. So help me understand, I mean, you were running a publicly listed PLC at the time. That was doing exceptionally well and performing probably beyond people's expectations. What led to that transition and you deciding to leave that operating role to transition into BlackRock? And I guess what were some of those motivators and variables that drove that decision?
So the one thing I know about myself is I need to be continually challenged and sort of be learning in a sense. And I learned that early off, even when I was doing stuff in college. Once I'd done one thing, I didn't want to do it again. And in a sense, whether you call that a sort of a boredom or something in my makeup anyway, I need the newness. I'm a complete change junkie. And so kind of that NTR job wasn't one job. So I became CEO of a toll road company, 2 toll road assets. 98% of the employees literally on the plaza. Had to take a strike in my first year. That was fun. But basically, the next phase was diversifying across the infrastructure spectrum Ireland. A lot of partnerships, some acquisitions, as we built out in water, waste, telecom, and power. And then as we began to go international, I got a whole new dimension. So by that was covered the period, say 99 through 2002, 2003. By 2003, we were beginning to go international. And then we had this phenomenal run, a whole pile of exits prior to the crisis, and then a new investment cycle on the far side of the crisis. But I think July 10, which was my 10-year anniversary as CEO, I went to Tom, who was chairman, and I said, look, I'm going to see this cycle through, but I'm not going to do it again. I felt we were developing a very strong team, and I didn't feel the need. And there, in a sense, it felt like a time for change. But the interesting thing for me was I didn't have a view about what to do. I knew I didn't want to be a PLC CEO. Being a big fish in a small pond can be great fun, but it's also got its negatives. And I had no interest in going to London. I still want to stay in Ireland. I just didn't want to be a PLC CEO in a bigger thing. I had such a proprietary interest in what I'd done in NTR. So I was actually beginning to struggle, what do I do next? Because I was not interested in a portfolio career. I know myself, I need to own something in a pretty fundamental way. And so then it was very serendipitous. Literally, my chairman, Tom Roach, shared a boat with the father of a guy who worked in BlackRock in Rhode Island, Newport. And the son asked the dad to introduce him to NTR. I mean, so completely serendipitous. And it really was only around the holiday period in late 2010, I realized that they really needed me to come across to make it a success. And so it played into this broader conversation I'd had. But for me, as I then began to evaluate it as a job opportunity, it suddenly, kind of opened up this new vista where clearly I was exploiting the competence in renewable energy and power and building businesses, but I was going to have to learn financial management and asset management, because in order to sell a renewable power product, I need to understand the whole portfolio. And so that really appealed to me, and BlackRock appealed to me as an organization. And people often ask me, as I say, I was employee number 1, and I moved to becoming employee number 243.5 on a good day. My son, on one particular occasion, was only 9 at the time, says, Dad, as we passed NTR, so who's the new boss at NTR? And I said, oh, it's Michael McNicholas. You wouldn't know him, but he was number 2, now he's number 1. So me trying to explain it to a 9-year-old, and he comes back and goes, well, Dad, he says, king never lets somebody else become the king. But, you know, swear to God, I almost crashed the car. Showed between pride, obviously, and a little frustration at his observation of my career choice. But, you know, for me, becoming, you know, employee number 243.5 wasn't an issue, because even as a CEO, you have a boss, you have a board, you have non-executive chairman, non-executive independent directors. Like, you know, unless, you know, there's a rare species of owner operator, but to my mind, you know, just, you know, I got the autonomy to go build a business within BlackRock, and for me, it was a fantastic experience.
And so I don't think a lot of people are actually that familiar with the story of Airtricity and the role, frankly, you and NTR played in the early success and ultimately the success of that business. Help me understand, what did you see in Eddie O'Connor? What did you see in that business that really drove you to invest both capital and kind of human capacity into that project? Because you really kind of accelerated the growth of that business.
So Eddie came knocking on the door in February '99, and literally, you know, it was him, it was Paul Dowling, and Marion, his assistant, and not quite one man and a dog, but 3 fabulous people. And look, you know, kind of he already had got it from his prior experience in the electric utility ESB in Ireland, and then our peat utility, for want of a better description, Bord na Móna. He managed to convince the EU that burning peat was renewable energy. You know, on I guess a 500,000 year cycle, it's renewable. But basically, he saw what was needed with respect to climate change and the energy transition, way ahead of everyone else. And what I would say to you about Eddie, he's one of these phenomenal guys who I would say, one of the rare people I would describe as a visionary, which is not just the vision of the future, but the stubbornness to go shape it. Because you can only imagine back in 98, 99, he started in 97, like no one was buying into this at any scale. I think the success, so the short version is effectively we invested about $3 million to take 51% of the entity. I went in as chairman, non-executive chairman, and then with the, you know, the solidity of NTR there as a shareholder and anchoring every funding round, I think we probably raised best part of 600 million, 700 million for that business through the early mid 2000s, and then effectively sold it in 2 transactions for $2.7 billion to E.ON and Scottish and Southern Energy in mid 07, or sorry, late 07 and very early 08, which I'll come back to. But I think what made that success as a business was, number one, you had this phenomenal individual, Eddie O'Connor, with this unbelievable drive, unbelievable energy to use upon, and this vision, as I say, and a stubbornness. And that stubbornness meant like just never taking no. And that took us from, literally, to give you an example, to build out our first wind farm in Ireland, we actually had to build a $75 million electricity supply business in order to give ourselves a contract. Okay. So, you know, and that was useful because suddenly we had the full value chain, we understood it. And so we went into markets like the US, the UK, and other China and elsewhere in Europe. We had the mindset of someone who understood the full value chain and understand where you could be successful or not. There's no question that the challenge in Ireland ultimately made us more successful as a business. But I think it was a combination of Eddie, and I describe him being in a kind of triangular force field, because a guy like that wears things down. And so you had the stability of NTR, 51% shareholder. I and 2 colleagues were on the board. I was the chair. Some weeks Eddie loved me with a passion, and other weeks he hated me with equal passion. And that's the nature of it. But we were there anchoring every funding round at 51%, which gave enormous stability to the business. But then he had some original funders who stayed involved, one as an executive, one at the board level, Louis Fitzgerald and John Lavery, that were a very powerful influence and constructive influence on Eddie as well. And then finally, it was an amazingly talented young management team. Paul Dowling, who I mentioned previously as COO, Senan Murphy, the CFO, is now CFO of COH PLC, one of the large Irish public companies. So that combination of the young talent, the sort of the close friends and advisors, and NTR, I think, with Eddie really providing the drive, created the momentum. And then look what happened then in 07, I think, was 2 things. One, we got big into offshore, and we as NTR were looking at that. And we did not believe we had the balance sheet to cope with that, frankly. At the same time, we'd gone out to raise money in the North American business, and Eon came in with a knockout offer in the summer of 07 that, you kind of just left us with no choice there. And frankly, with the broader thinking we've been doing, we immediately went into a sale. Now, never confuse a good dose of luck for brilliance is a line I tell my guys all the time, pisses them off most of the time. But, we launched that transaction early October. We had the bids due in on Friday, let me get this right. So due in on Wednesday the 19th. We allowed it drift 2 days to Friday 21st of December. We picked the winning bidder on Monday the 24th, and we signed on January 4th, 2008. Now, did we think equity markets were falling out of bed 2 weeks later? No, we didn't. But I'm telling you, if we'd carried the risk in terms of the capital consumptive requirement of that business into the crisis, it would have gone bust. You know what I mean? We wouldn't have had the balance sheet to cope. So, but it was a great story. Eddie, as I say, one of the few guys, he's gone on to do it again with mainstream renewable energy. And, I've done it in different ways. But we created an ecosystem of guys who are throughout the industry today.
Yeah, that's great. And we'll come back to that, actually, that operating experience in a few minutes. But I wanted to fast forward to today after giving people an understanding of your background. Obviously, we're living in a time of COVID. I personally feel like we're going to be dealing with this for at least the next 18 to 24 months. And so as you're, I believe, managing roughly 1,000 people in 35 countries globally today, how has your leadership and management style evolved over the last 3 or 4 months? What practices are you putting in place? How are you functioning in this world today and continuing to lead these diverse teams?
Well, look, I mean, the first thing I would say to you is if you're only getting it started out now, it's too late. So in other words, you have to have, the right people, the right structures, the right processes. And I'm a huge believer in the power of strong process to go with talent, whether it's running a business or building a business, but also investing in particular. I think, look, I've a very heavy touch leadership style. I want to know all my key people, and even not the key people, really well in their totality as individuals. And so, I'm massively leveraging that at this juncture because I don't have the opportunity of all the informal interaction I would normally have with people. And so, a big part, so I'm leaning on the past in terms of the relationship development, but at the same time, leaning in and using the technology in all sorts of ways, in a narrowcast one-on-one way or a more broadcast way. I think that we clearly had to create new process around the crisis. I mean, when this began to build in February as a really, it did migrate from being a Chinese, global supply trade issue to being a global issue in that time frame, we began to, kind of step back and think about it. And so we immediately put new processes in place. And I would say the communication is critically important in times of stress. I mean, stress tests people, behaviors change. Stresses challenge your structures, challenge your processes. And so there's no question we put new process in place. When we had to have a very clear process around the portfolio. That mid-March onwards, put in a deep stress test in the whole portfolio, not to re-underwrite, but to actually work out where we had problems. So we could prioritize our focus on the portfolio. And then by the time we got to April, focus on those assets that needed more help and re-underwrite them in a sense. And the challenge in most of my business, the alts business, is it's a private market business. So I don't have the luxury of pivoting my view in 3 weeks' time and reallocating the portfolio. When we write that check, either in a re-underwrite in a stressed asset or in a new asset, I got to take a view on where we're going in the short term, what the nature of the clawback is, and what's the structureship. Does this business have a business model? And if it is, what does it look like? Because there's no doubt in my mind, we're going to see acceleration of structural shifts. We're going to see momentum behind things that were only just kind of beginning. The former would be obviously retail online. The latter would be something like global supply chain reconfiguration. And then there's new dynamics around how are people going to use space going forward. And so, you're trying to get the answer to that now, where we are, is bloody difficult because you just lift up, it's Pandora's box. You lift up one issue and there's issues everywhere. And And so it's a challenge, but communication, new process. But the other thing you've got to be very careful in this climate is everyone's experience is unique. I've got, in practice, almost 4 adult children in the house. So, you know, that's a very benign environment. You know, most of them are functional. It's a reasonably benign, I won't say which one isn't. It's a mostly benign environment for working and operating. And my wife is a full-time mom. And so you know, kind of, that's in one context. But, you know, if I'm in an apartment with 3 other friends in my mid-late 20s, you know, with hardly room to scratch, that's another. If I've got young kids, both parents are working, that's another. If I'm having to care for an elderly family member, that's another. And so you really have to be very sensitive to that specific circumstance in a world where we've had this blurring of work and home life. Yeah. And so what I've done a lot in the last 6 weeks is actually pull back the process, step back from frequency, step back from the weight, so people get a little bit more space, and then being very deliberate about forcing them to take time off. And more than that, then I would say, look, the classics around leadership, authenticity is critical in my model of leadership. And, you know, so you got to double down on that. You got to treat people as adults. You really, really have to, you know, give them responsibility, support as necessary, but not smother them. And then you got to just, you know, and I think I would say to you, you know, and you got to see who are coping well and who are not. And those are not, you have to, you know, kind of lean in and support or take other action. But look, it's more demanding. But look, at some level, I was always on a video or a phone with somebody because I was traveling 250, 300,000 miles a year. Everyone wasn't traveling with me. So there's not a huge dynamic there. But I do think what you miss is the informal dimension to the relationships. And so that's why I say to you, I don't buy this idea that offices are dead at all. I think there's changes to how they'll be used. But I fundamentally believe we, as human beings, we need that social interaction, and we'll be back to it. So maybe not at 250,000 miles a year.
Well, so on that point, that last point, whenever you talked about real estate and specifically commercial office space, how's COVID affecting your own asset allocation strategies? I mean, most of your holdings and most of the assets you're responsible for are long-term. And so as you think about the impact for global travel and, you know, financing airport expansions versus retail malls, things of that nature, how are you thinking about the long-term impact that COVID has?
So look, I think there's a couple of dimensions to that from my perspective. The first is, I would say to you, we are not dealing with the GFC, okay? And I'll tell you, in my world, let's make this a private market conversation. I'll ignore the liquid loans. GFC did not have the same scale of dry powder. $2.5 trillion is one estimate I saw of dry powder available for investment in private markets on the backside of 2008. And I think also investors today are way less gun shy than they were immediately after the trauma of September 08. Because they've seen, we've all seen the success of the post-08 vintages. And the third thing I would say to you is that 2008 to GFC recovery, that tide lifted all boats. To my mind, there was very little dispersion in the outcomes. Completely different this time, in my mind. And it comes down to the fact that the second dimension is, I think we're going to see, obviously, some sectors more badly hit than others through this immediate economic slowdown and recovery. But then there is long-term shifts and change, which to my mind fall into those categories of acceleration of structural shifts like in retail, you know, momentum behind shifts like in global supply chain, and then new dynamics fully introduced on the back of say use of space. But so in terms of my posturing with respect to new investments at this juncture, so the first thing is my mantra all last year and for the 18 months, probably back end of 18 all the way through into early 20 was discipline, 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 as we saw excess everywhere. And you know, and in a sense, discipline is still the byword, but I'm adding to that patience. I don't think there's a price for being the fast mover here. I don't think I've seen the prices move. And the challenge, even when we see a good asset, John Salters had our Asia real estate business, very funny last week. It was a particular asset, really attractive asset in one of the major Asian cities to come to him. 50% shareholder want to sell down, want a liquidity. And so you look at it, big discount, price looks great as against, kind of, let's call it October, November. And, okay, so look for something else. I'd like to go in preferred. 24, yeah, you can come in preferred. Yeah, okay, maybe can I have a cash? 24, yeah, you can have that. So every time the guy came back offering more, he got more and more nervous. So the challenge is the price may look great as against November. Is it the right price for the risk in the asset now takes? I think that's our biggest challenge, and that's why I say patience at this juncture. I would say that so there's going to be much greater dispersion. We're seeing it across sectors clearly, travel, tourism, leisure, hospitality, carnage. But even so in an area like healthcare, and we have a very defensively positioned portfolio across our alts business, but healthcare has winners and losers too. Anything elective is being crushed. So that's short term, but there's all these unintended or unexpected consequences in the mix. Interesting, one of the weaker areas of rent collection. So you might expect retail, we're at about, since the March period, about 65%. But industrial, 76, 77%. There's been tensions in the mix there where corporate's about 85% and multifamily apartments up about 95% as a kind of a weighted average. So you're having to work through all of this, but my bias is towards real quality, I have to be honest, and resilience. So if you're in an area like infrastructure, I'm looking at the highly contracted, public-private partnerships, availability-based, contracted power, really strong midstream assets with really high quality credit where otherwise you're importing a whole load of pain. And then on transport, I think price, what do I think? I think, look, if you're in a toll road or an airport, I think your value has changed, okay? But I do think the road is more resilient. I think it will come back. We've even seen out of Asia, people pivoting out of public transport into the road asset. Ports, you got to be very careful. How are global supply chains going to shift, and is it good or bad for a specific asset? But airports, I've very little direct equity exposure, but I have a pile of debt exposure to airports, and I'm very comfortable with that because I'm attached between 6 and 8 times EBITDA on an asset trading 24 times EBITDA. Is that worth 24 times EBITDA? Not a chance in hell anymore. And so the valuation impact. But do I think that it remains in game? I think if you're in a major strategic airport, it's absolutely resilient. I just think it's not worth as much as what it was. I think leisure will get back there sometime in the 23 period, 22, 23. Business travel, I think, will take longer. I think there will just be permanent structural choices made there. But look, that exposition on airports, and by the way, I'm really negative on the ecosystem for airports, okay? The service providers, et cetera, and plane manufacturers and that whole dynamic. But that's just one, like we could spend an hour on every category today. There is so much change coming our way, and so a real bias towards quality. And by the way, but this is the time for alpha generation because of the dispersion. This is where the good active allocator, private or public, I think proves themselves out. Yeah.
So actually on that topic of change, I mean, Larry Fink, I think surprised a lot of people with his letter this year on the topic of ESG. I mean, give a minute or two of background on that letter and what it meant for BlackRock and frankly what it meant for the broader industry, but then help us understand how you're applying that ESG lens or filter to your own asset allocation strategies. And are there deals that you did last year that you just can't look at right now?
So I would say, so first of all, anyone who's a close Larry watcher wouldn't have seen it as this massive leap in the sense that, his CEO letter has become kind of a pre-Davos event, for want of a better description. And he has been really big on long-term thinking. He has been really big on companies having a very clear sense of purpose of what they're about as a business, which really brings down that stakeholder dynamic. And then sustainability /ESG is just kind of an articulation of one key dimension of that. I think, look, internally, you can imagine in BlackRock, $7 trillion plus or minus, there's a range of investors, there's a range of sensitivity to this. But we also are an intermediary. We are representing pools of capital that are owned by pension funds, insurance company, endowments, individuals. And so we're talking to them all the time. And in a sense, we've taken a leadership step, but we're only beginning to reflect a general movement among the providers of capital as they in turn respond to their stakeholders. And look, if I give you the idea, the example of a renewable power fund, right? So the first one, which was eventually a $611 million fund, GRP1 as we call it, Global Renewable Power One, we had about 45 institutions, and if 2 had ESG as a factor, raised in the, kind of let's call it 11, 12 into 13 period, if they had it as a factor, that was a lot. By the time we closed GRP2 in 17, $1.6 billion, 75 institutions, probably plus or minus. If 10% didn't have it as a factor, that was a lot. In other words, there was a pivot. At that stage, I would say to you, still kind of a little tick in the box, but it was suddenly on the agenda. And with GRP3, which is already, it's moving towards $2.5 billion, it's about 1.6, 1.7 raised. I would say to you that that it's now a very active allocation. And what you've seen over time is that the various executives in all these institutions are getting the message from their boards and trustees, and now it's feeding in. Now, no one's willing to take a return haircut just yet, maybe slightly on the margin. Everyone wants to feel they're getting a fair risk-adjusted return for their allocation. I think there's very little money for that pure impact product, where there's a sense there's other metrics other than return on capital in the mix. But when you move into the liquid space, and we're doing a huge amount on data, we're seeing ESG criteria driving out performance on a relative basis. And I think that's more than anything else is driving allocation. And so all that fed into an internal conversation, which had then Larry craft this view about BlackRock's role in driving the sustainability agenda and playing a leadership role. And I think, look, and the other thing we fully understand is that it wasn't like we've got to a point. This is a moving line. And in my view, then, to get to the second part of your question, like what we think about sustainable today, to my mind, is mainstream in 7 to 10 years' time. I think as I look at ESG criteria, it's a risk filter, which in real assets we've had for 5+ years. It's either something where there's a cost to today, or there's going to be a cost over the medium and long term, whether that's in regulation or in tax or whatever it may be. And so you have to understand that. And so to my mind, there was no pivot for my world in January. It's been there at some level. But I would say to you, what's driven my view on my asset allocation in infrastructure, as an example, is much less Larry's letter than the fact that I think the sentiment around climate has shifted dramatically in the last 2 years. I think the mid to late 2018, and I've been looking at this space 20 years, I think there's been a shift. Paris Protocol was great in the sense that it ended what I would call any rational challenge to the science, but in any way really adapt policies or suggest implementation of policies that will address the issue. I think what's happened in the last 2 years is that the public have become agitated on this in a way that just wasn't there before. And I think it's now in the politics in the mainstream, which is going to drive policy. And I think, look, and so to my mind now, I'm much more worried about stranded assets. I haven't been doing coal for 10 years, but now I've got to look very carefully at other fossil. And the issue for me isn't whether I can get in today at a very attractive price. The issue is, can I get out of it again in 7 years' time or 10 years' time? Is there going to be a 20-year, 25-year life on that asset at the end of this decade that allow me exit? And so when you begin applying that filter, things begin to look a lot different.
Yeah. And so how do you believe COVID and the austerity measures that are being taken by governments and states and companies will affect the focus of ESG? I mean, is it going to take a back seat to what we're dealing with now in terms of both health and kind of social impact?
So I think it depends, and it's going to be country by country in a sense, or region by region. If you take something like the EU, I think if you take someone like the EU, I think they will take this on in a way because bigger question. But we've seen it on precedent scale of monetary and fiscal intervention. There's even more required, way more required. And I think that the question is, can that be directed in a sustainable way? And I think the smart and strategic governments will do that and do that very materially. I think but at the end of the day, we're going to be dealing with massive fiscal deficits, and which will have to be addressed at some level. And I think that it will force negative dynamics, and I think it will also provide an opportunity for the vested interest to try and influence things in a way that are negative for, say, an area like renewables. But fundamentally, I think this is just a ball that's rolling downhill, and I think there will be twists and turns over the next year and a half, 2 years, country by country. But I don't think this is going to stop at all. And I think that for the smart regulators, policymakers, there's a way to accelerate on the back of the massive scale of fiscal investment that we're going to have.
Yeah, interesting. So I've already integrated 2 or 3 questions that we received last night into the questions that were already posed, but I do want to get a few of these other questions in front of you. And this one I'm actually quite curious about. How are you approaching due diligence, whether on asset-based investments and due diligence that's required, or fund level investments? How are you thinking about due diligence now that we live in this world today?
So I guess, it's difficult in a sense, and we're having these discussions, as you might expect, when it comes to physical assets. Look, I would say to you, first off, I think there will be an easing of dynamics in a way that allows people travel again at some level, and allows some physical access. But we are talking to consultants about different dynamics. We're talking to them about drones, for example, as a way to get a view of the site, using videos in buildings to give a tour of the site live, using the FaceTime equivalent. Where it's funny, we're doing a deal in Taiwan, and we'll need to get there for this one. And we have, the great thing is BlackRock has people everywhere. They may not be the right people, but we're in 76 countries. But I do think that, I put my hand up and I said, I'd go to Taipei, even if I have to get a bus. I need to get out of here. but no, I think we're just going to have to be creative. It will slow things down, though. I mean, you can't expect to move with the same efficiency and effectiveness. But can you get stuff done? I think you can. And I think there will be sufficient let up in the dynamics to allow you be effective. But it will be slow. Your productivity will be slow. There's no question.
Yeah. What specific sectors post-pandemic, and we could debate whether, what that actually means and what the definition is, but post-pandemic, what are the most interesting sectors for BlackRock?
Well, I mean, I guess anyone that's not going to be crushed or have their business model structurally changed. I mean, let me just talk about our world and all. I mean, look, I would say to you, it's a flight to quality across the platform in a sense, and also without necessarily looking for that incremental return, and there is an element of incremental return, but just getting lower risk for, as we judge it, for a headline return level. We've seen a lot of investment grade drift down into the sub investment grade area and in the liquid loan area, and also liquid loan drift into the private loan space, direct lending space as well. And so that's a nice opportunity, but you got to be careful and thoughtful. And so, look, we're backing the obvious sectors: technology, software as a service, healthcare. Again, got to be thoughtful about some of the more elective areas, but we're playing into logistics, we're playing into telecom infrastructure. So, it's like, because I do think that, there's a few new dimensions. Like I am wary of space utilization, the productivity per square foot. In terms of I need more space at home. I'm now killing myself. I didn't persuade my wife to put on the extension 3 years ago because she's the one at home. I'm on the road. Oh, well, there we are. But it's more space. But we'll need more space per person in an office, but we'll need less people in the office. And so trying to work all these dynamics out. So I'm not a buyer in the end of urbanization. Human species has been dealing with pandemics in cities with much greater economic and life costs in the past. The city works. It's got the efficiency, effectiveness. I think it's necessary for climate change done right. But will we use it differently? Will dynamics around retail change? Will dynamics around office change? Yes. But I think our considered view is, for example, that high quality central business district is not dead by any stretch of the imagination. And I think people will still want to work together, maybe slightly different ways. You know, I've loved this time at home with the family, but you know, you can have too much of a good thing.
Yeah, I agree. Last question for you, and then we'll try to wrap. What do you believe is the outlook of renewables in clean energy? And specifically, I'm kind of curious about how you see traditional fossil fuels and the pricing in the market. You know, is that headwind for renewables and clean energy in terms of adoption or not?
So, okay, number of different dynamics to that. So first of all, the great news is I don't have to start my client presentations on a stage or meeting anymore with the fact that climate change is real and one needs to get used to dealing with it. Less so anyway, still a bit in the United States. But the, look, renewable energy is one element of what's going to be a massive energy and power transition over the course of the next 25 years. And the reality is, unless the science is wrong, we need to massively decarbonize our whole economic system. And there's nothing to suggest the science is wrong. If it's wrong, it's wrong actually on the upside to the impact, i.e. we're going to see much greater impact, much quicker, more extreme, in my view, on all the data I see, than is in the ISPC report, the UN IPCC report. The reason why is that you got to remember that was the lowest common denominator process, okay? And that's why you're seeing everything to the downside of those predictions. So that's going to accelerate in my mind. And so the first thing I would say to you as an investor, we have to plan for mitigation. Okay, so we will be dealing with the consequences of climate change. The question is, how extreme will those consequences be? But certainly, as I say to a lot of people, I wouldn't be buying anything at sea level on a personal or institutional basis, okay, without a really high wall. And they're probably not high enough. Then the dynamic on energy transition. I think power will be the easiest to change. And I think that the reality is oil's gone where it's gone, but oil is not a driver of the power economics, it's gas. And gas, ironically, has shown more firmness with oil falling off, as particularly that gas coming out of the shale oil supply has come off the system. But gas is still cheap and will stay relatively cheap over the medium and long term, in our view. But gas itself, that's without the carbon cost. The good news is renewables have collapsed in price over the course of the last 10 years, both on the solar, particularly, but the solar PV to a lesser extent on the wind, but still coming down, particularly on offshore wind coming down now. I think that's going to be a dynamic in the US, which it hasn't been before. But before you get to the cost of carbon, you know what I mean, renewables are competitive now. And I think that what's really going to change the dynamic is storage. And if it was left to the power industry alone, it would have been very challenging. But what we're going to see, and the need for a lot more spinning reserve, but what we're going to see, and gas having a bigger role. But I think that with battery technology being deployed in transport, it's going to get the scale deployment that brings the effective cost of storage down as the technologies improves efficiency and the effective cost of production reduces. And so, you know, that's very dramatic as I look out over the next 5 to 10 years. The only reason coal is still in the system is because there's a lot of emerging countries, you know, like India and China, when I argue they're not emerging anymore, but in a sense have been reliant that the Chinese are still exporting coal for geostrategic reasons. That has to be dealt with. I'm not a buyer of carbon capture and storage. It's just, I just don't see who's going to invest the tens and tens of billions to make that anyway cost effective before you ever get to the liability on the carbon. And so, so out of a few specific instances, that's not there. So it's going to be renewables and storage. Gas has a transition role to play, no question. But, you know, kind of, and the challenge for coal is, you know, if you can get your money out of coal in a 3 to 5 year period, all cash, you know, income, you know, there could be really attractive returns to make because the capital, we're not putting capital in. Our clients don't want us to put capital into coal. We have clients who want us to put capital into shale gas because of its extra climate impact. Yeah, the capital is going to drive a lot. And so, you know, when Germany says we're out of coal by 2035, it means they're probably out by before the end of the decade because no one's going to put $1 into an existing coal facility. Who's going to fund that? And so capital is going to be a big driver of the dynamic. And we're going to continue to see cost efficiencies. I mean, we're seeing long-term fixed price contracts for renewables, around the world that's, kind of on the solar side, 2 cents and lower now, you know what I mean? And and it's like, it's almost power for nothing. But let's not underestimate the vested interest will resist. And no question. And I keep making the point, we need to pivot from a sense of there's a cost of transition. It's not. What we're going to see is a reallocation of economics in the system away from those who were getting the rent on the fossil in its life cycle without paying its full cost. And I think that, I think that'll become much more evident. But look, it's not a one thing yet. I think there's, the power of the vested interest is still enormous. And so you will see, look, there's a current administration in the United States that, is effectively encaptured to these interests in a much broader way than just on climate, broader environmental regulation. And if that administration is there for another 4 years, that will be very negative in that time frame. But there's an inevitability about all of this. There's an inevitability.
Yeah, interesting. Well, Jim, thank you for joining us today. I'm sure that we could have spent another few hours talking, but
I'm Irish. Audience know where to go. I definitely could talk for hours. Not a problem. But no, delighted to be part of the conversation today, and appreciate the invitation. And I hope your listeners found something of interest.
Wonderful. Thanks, Jim.
Absolutely. Yeah, and thanks, Jim. I know there are a couple of very interested listeners, and we're waiting for a big press release over the next couple of days as well. Big announcement coming out of BlackRock, and yeah, really greatly appreciated. Thank you for taking the time, and I know all of our listeners, and everybody stayed on actually throughout. So really appreciate the content, great information, and wish you and BlackRock the best with your new investment.
Thanks, Andy. Appreciate it. Thank you.